What is going on, everybody? Q here from Hyperstocks. Today, we're going to go over the recent events of the market. We're going to talk about the decline of the market and what we can expect going forward and what are the key things to pay attention to. So, this week, starting off December 2021, the stock market took a downturn. We saw the first day of December end much lower than the end of November. We can see that in November we reached highs of 472 or 474, and now we're back down to our 50-day moving average, which is this blue line right over here. So for the last 50 days, we can see on this left side right over here, the 50-day moving average has traded for around 453, and currently we're trading around 455. So we are down at the 50-day moving average. This has happened 1, 2, 3, 4, 5 times in the last 3 months. So this is not out of ordinary that this has happened. One thing to note, however, that this time around we are seeing actual policy changes coming from the Fed. Nothing is implemented yet, but they are looking to change some policies around interest rates and tapering back on the asset and bond buying. So for the first time since COVID, we are seeing policy changes. So this was the COVID rally all the way from these lows to these highs. And for the first time since, we are seeing these changes. We're seeing the Fed take a more serious tone to these changes. So they're likely going to come early next year. So the market is kind of having a tough time, taking ease on that. And the primary reason is because when you raise interest rates, and that's what the Fed is looking to do. So interest rates right now are nearly at zero, making it very cheap to borrow money for both the consumer and companies. Therefore, the economy has a lot more stimulation in it. But when you raise those interest rates, now you're risking a little bit less spending because it's more expensive to borrow money. And so the market obviously does not like that. They want the economy to be stimulated. But in regards to tech and in regards to this actual rally, we can definitely see that this is just a small notch in the road compared to what we've been doing. But it is not, it's not something to ignore. You want to keep an eye out on these things and you want to see the latest developments. So, a lot of news headlines and whatnot, they're going to tell you that this is caused by the new Omicron variant from COVID-19. But unfortunately, that just was part of the spark that took the market down. There's a lot more on the back end and from the Federal Reserve that's causing this downturn as well. So we have the new variant and the Fed that are causing this downturn. So what are the key things to focus on, and what are some things that you can do in this case? First of all, being down at the 50-day moving average, we can see that yesterday we came down to that 50-day moving average and we came below it. Today we bounced above it. We had 2 back-to-back days of strong selling, actually 3 if we consider last Friday. So 3 back-to-back, 3 days of strong selling within the last 5 days, followed by a small bounce. This bounce did take us back above that 50-day moving average, but we can see that buyback volume is not yet impressive, and we're still below that 10 and the 20-day moving averages over here. So what we do know is that 450 is a very critical support for us, and the reason why that is because that was the lowest point that we came down to before we bounced up. So being that point in which we bounce, it becomes a very strong support that we need to focus on. So 450 would be the very strong support that we need to focus on. And then in terms of the pattern we're making, we need to break back above 466 for us to really be safe, because that's gonna be us making a higher high than the previous high that we made. So there are 2 points to focus on that we need to get above, and that's going to be 460 and then 465. So as long as we're down here in this territory, we're at risk of moving down further and testing potentially 444. And if we manage to do something along these lines and move ourselves back into a healthier territory, so something like this, and this is likely going to happen through December and January. This time of year, it's not unusual that we see a pullback, but it's very unusual to see an actual market correction. So I don't foresee us going through a severe correction. I do foresee us, climbing our way back up and heading towards new all-time highs by the end of January. But the recovery is probably going to start much sooner than now, only because we are expecting a Christmas rally. So if things do get worse, we can potentially see something happen that takes us further down. But I don't foresee that happening. However, it's the signs are there that we need to be more careful, and we need to approach market a little bit more critically and with more strategy. And that strategy is by being modest in your positions. You don't want to go for those big runners. It's no longer a time of rally. You want to focus on, if you're day trading, you see profit, you take profit. You're not going to be holding positions for too long. If you're swing trading, I would recommend that you give a little bit of a longer timeline for your trades to come around, but keep a tight stop loss. And if you're position trading, you got stocks like Visa, that are completely down. You got stocks like PayPal that are completely down. So these are all stocks that are excellent for long-term entry opportunities. PayPal way below all their strong moving averages, so they're very, very attractive right now. So you got a lot of different companies that you can work with. Pick them up on the low and take advantage of these pullbacks that are taking down the market. But also do it with, a critical eye. You want to be more patient. You want to pick up the companies that have the stronger fundamentals. If you pick up the companies that don't have a lot of cash flow and revenue, and they're young companies on the market, in the event of a market correction or a market crash, you're going to see those companies suffer the most. Companies like PLTR, for example, companies like Fubo, for example, they're companies that are, they don't have a large number of, customer base yet. They don't have a heavy revenue supply that they can kind of survive a market correction like your Microsofts and your Apples would. So, I wouldn't worry about a market correction just yet. If anything, take advantage of this downturn and perhaps see those really discounted stocks, and then keep an eye on the S&P 500, see what it does. But when you really look at the long term, we're far, far higher than any critical territory. Markets are just having a small bump in the road before potentially moving higher. And if we do move lower, it's an opportunity for us investors.